Ever pondered on the question, what is speculative risk and how does it affect your investments? If you have, then you're in the right place. Speculative risk, by definition, is a category of risk that, when embraced, results in an uncertain degree of gain or loss. It's the possibility that an investment may not appreciate in value. Unlike uncontrollable circumstances, speculative risks are conscious choices made with the understanding of a potential large gain, despite the high level of risk. This makes speculative risk distinct from pure risk, which involves only the possibility of loss and no potential for gains. Now, let's delve a bit deeper. Almost every investment activity carries some degree of speculative risk. Why? Because as an investor, there's no certainty whether an investment will skyrocket or plummet. Some assets, like an options contract, carry a blend of risks, including speculative risk. But the good news is that these risks can be hedged or limited. So what's a speculative investment? It's an investment where the fundamentals don't show immediate strength or a sustainable business model. Instead, the investor anticipates that the price may rise due to other factors, or that future prospects will outshine the current circumstances. These types of securities may have a high level of potential upside, but also a hefty degree of risk. Think of it as a penny stock or an emerging market stock that an investor expects to become more favorable in the future. It's worth noting that some investments are more speculative than others. For instance, investing in government bonds carries less speculative risk than investing in junk bonds because government bonds have a significantly lower risk of default. And in many cases, the greater the speculative risk, the higher the potential for profits or returns on the investment. A speculative risk has the potential to result in a gain or a loss. It's entirely voluntary, requiring input from the person willing to take on the risk. However, the outcome of a speculative risk is hard to predict, as the exact amount of gain or loss remains unknown. Instead, investors use various factors such as company history and market trends when buying stocks to estimate the potential for gain or loss. To wrap up, speculative risk is a conscious choice made by an investor, with the understanding of the potential for a large gain or loss. It's inherent in almost every investment activity, and the outcome is hard to predict. However, the greater the risk, the higher the potential for returns. It's a game of risk and reward, and the key is finding the right balance. So the next time you're about to make an investment, remember to consider the speculative risk involved.